Hey guys, welcome back. Tuesday, June 9th, 2026, and we just witnessed one of the most violent massive intraday swings on the Nasdaq Wall Street has seen in the last few years. Now, just because asset prices are so much higher today than they were years ago, this wasn't necessarily a record-breaking price swing, but in terms of actual cold, hard dollar value wiped out and then recovered, this is the kind of intraday swing that's only happened a handful of times in the last decade. But here's what's fascinating. The massive plunge and subsequent recovery lined up perfectly with our expected moves in key Fibonacci extension levels. So you guys know me, just because we found a ton of structural support at the lows doesn't mean that I take this as definitive proof that we're going to instantly blast off back to all-time highs. However, let's look at how the bond market, via TLT, has been behaving today and the last few days, and the sheer nature of this sell-off to reversal, the very swift one at that. And this doesn't look or feel like an inflation scare to me. It's something else is brewing under the surface ahead of tomorrow's major data drop. And while we certainly can't know exactly what that is, we can break down the charts to see what they might be telling us. So quick disclaimer, this is not financial advice. This is for educational purposes only. This is how I'm reading the market, managing my own portfolio, and thinking through trade architecture. So please hit subscribe to follow for more. And thank you everybody who subscribed. I really appreciate it. Thank you for all of the comments. I really appreciate that too. It helps me continue to make these and make it worth it. These take a while. And I've been making more actual on specific trades. So just leave a comment what you'd like to see more of, and I'll focus on that. So let's start off with the index reviews. So on QQQ, that was probably one of the more wild situations today. The actual range of today's candle was $39.29, even though we only finished down negative 1.15%, and we were down like negative 4% at one point. So this was quite a reversal, even though, like I said, we hit this fib extension, which is from the previous breakout when we had been consolidating for months towards the end of last year into this year. This whole multi-range. So we had the Fibonacci's for the actual breakout, and then these are the extensions. And so we came back down into that almost perfectly. It also coincided, interestingly enough, with some of the pivot points, although I would have expected it to have bounced sooner, but it makes sense given the Fibonacci retracement level. And so then if we look at the SPY, similar story in terms of trajectory, but we're down only 0.29%. The Dow Jones, similar thing to the SPY, it was up 0.1%, but it had quite a swing as well, and it found support based on its previous breakout. So let's look at IWM, because I think this is an important one to check for the broader market health. The small caps via the Russell 2000, IWM refused to break down, and they finished the day in positive territory, but similarly had an up-down day, but actually finished quite in the middle of that range there. But the fact that the IWM held green tells us this wasn't a broad market liquidation event. It was highly targeted. So now let's look at the sector review. So today was absolutely not a blanket risk off day. I know it could have felt like that in the middle of the day if you had been actually, day trading, but if it were, everything else would have been leaking instead. So it was an incredibly aggressive rotation of a few select areas and then right back into them in some cases, but into values and defensive. So if we actually look at the broader market here, looking at financials, this other lower end of the market here, financial, healthcare, industrials, utilities, real estate, materials, and many consumer staples were solidly up today. So we saw heavyweight strength in names like Berkshire Hathaway, Johnson & Johnson, Caterpillar to anchor the market, but even certain names that we've been watching for a while. I think even Campbell's was up 2.98%. We still have two call options on that. But, just to give you a sense of what was going on in the market, granted they had earnings recently, but a lot of the lower end in fact, I actually think that XLP itself was up, 1.24%. So that should give you a sense of where people were looking in the market today. And then to round out that macro picture, looking at sectors in general, and I will get to one or two more sectors, specifically real estate. Although if we look at financials real quick here, that's also up almost 1%. So I don't usually buy that the market is having a liquidity crisis, which is what people seem to think was happening today when I was looking around online. I check in on sentiment. I have a few algos running to pull that sentiment for me, and people talking about liquidity crisis and things of that nature. I generally don't tend to believe that when the financials are on an up day, or even if we look at XLF in the slightly longer term here, we are holding up okay. So that's not a liquidity crisis in my mind. The same when we're talking about TLT, which is actually what I wanted to get into here. Now, this hasn't been doing great in the long term, obviously. But to round out that macro picture as far as sectors, which I will treat this either like a sector or an index, given depending on the day and the point I'm trying to make. But if we throw that into the mix, bonds caught a steady bid today. It was up almost 0.6%, which is a nice move for TLT, causing yields to sink. And when bonds are rising alongside value sectors while tech softens, the market is signaling a flight to stability, not panic over a hot inflation print. Although sometimes those two things do look a bit similar. But again, that reversal today seems to indicate that this isn't just everybody freaking out over inflation. So why was software down so much today when compared to everything else? Because that's another sector I'm always watching here because some of the trades that we're putting on, although that does look like a really nice technical level that it is has approached and held. And we actually on the 4 hour are seeing some nice. Do we getting divergence there? No, not yet. I'm always looking for the 4 hour divergence first. Those tend to have some nice near-term plays. But anyway, why was software down so much today compared to everything else? And it comes down to a massive structural bottleneck. Institutional investors have spent the last 3 days aggressively scrutinizing enterprise software budgets and AI infrastructure spending ahead of tomorrow's massive Oracle earning report. Where is that true? Did I get their earnings date correct? No, that is correct, right? And yeah, it's on the 10th. So everybody's been checking that out, and the street is terrified that enterprise AI monetization is taking longer to materialize than originally hoped, causing big funds to trim software exposure and park the money instead in steady dividend-paying defensive sectors. Now, it's going to be interesting how that plays out. I mean, Oracle is, the chart looks very similar to IGV and to a lot of other names that are in that sector. And, we're going to get into that when we start talking about some of the trades and structural setups for today. In fact, let's jump right into that. So let's talk about those trade ideas and core structural setups. And I want to be completely blunt with you guys. We're not forcing a ton of new trade ideas today. The macro data dropping on Wednesday, Thursday, and Friday is the most important piece of the puzzle for understanding how we should safely position our capital going forward. Just remember, we've had a pretty significant move since March going into until I guess on Friday. And so after a move like that, I don't think it's reasonable to expect another great move like that. Not to say it couldn't happen, but it seems more probable that we would have a pullback in time, meaning that we consolidate for a while or we pull back a bit further. But I'm not just closing my book just because. Based on that, though, I don't want to give too many trade ideas. We just need to wait for those pieces of the puzzle to come in, and we can understand how to position safely with our capital going forward. And I don't really like to gamble ahead of binary events. It is a lot harder to algorithmically trade some of them in the book, meaning I have day trading algorithms that are running for scalping, and they do something completely different. But as far as these positions goes, in the portfolios that I'm showing you, that's not the type of algorithm trading that I'm doing. It tends to be more swing trade and slightly longer time frames, but it also has intraday entries and position management and risk mitigation. So let's get into those specific trades. So for Microsoft, we've been talking about that, if you watch the Wyckoff structural video I put out earlier today, the price action should make perfect sense to you. But software as a whole has been getting absolutely slaughtered today. But Microsoft showed incredible relative strength by holding its structural levels beautifully. And again, this was a video I put out earlier about how we could have identified this point given a larger Wyckoff analysis of this. But I think, again, we're going to have to wait till tomorrow, specifically with Oracle, but also with the CPI. When a mega cap monster refuses to break down during a sector flush, you kind of note it. And even though we have been flushing before, this has to do with the rejection off the 200 SMA and the assumption that this is the first breakout retest here, coming back down into a trading range. So the other trade I want to look at today is similar in the sense that it's a long-term chart that we're going to look at. If we look at IYR, or if you, essentially the real estate ETF, on the daily chart, actually, let's start there. We can go up to the weekly, although the weekly and the monthly are just looking great. For the monthly, I love this kind of trend line breakout, but I don't blindly trade that. And with the daily, we are also we're starting to at least consolidate around this breakout up here, but it's looking really good. And it's one of those things that I said on Friday, if rates were really having a problem, do you think that institutions are going to be going hard into IYR at these elevated levels? I don't think so. There's not a lot of incentive to be doing that unless they actually truly believe that rates may be coming down, or at least not be raised, or at least some dovish Fed speak. So, and time will tell as soon as we get that first meeting. But so I do like it on the weekly, very much so. I like it even more on the monthly, and on the daily, it's compelling to me. This is a play that I actually have in my dividend portfolio. So I don't trade this actively because the swings aren't enough for some of the approaches, but there is some nice opportunities there. And in IYRI, which is my preferred way to get income from this, is the NEOS Real Estate High Income ETF based on the IYR. The dividend really offsets this, especially since we've been chopping for, let's put this on we're going back a year or so. And so the dividend really offsets that. And like I said, it's showing some really nice strength, even given the fact that people do think that there's some type of inflation issue, which I'm not even talking about the inflation you and I feel, and I don't want to get political on anything. I don't think anybody can say that they're paying less for things, but what I'm talking about is the way that inflation is influencing the market. So inflation scares, or inflation expectations, I suppose, are a more important way. You need to divorce your anecdotal experience in life from actually the financial markets, although they could be useful data points for sure. So those are the two main trades I wanted to talk to you about. IYR, if you really like this kind of thing, and I don't hear a lot of people talking about it because it's really not that sexy of a trade, but it's a great dividend income play that I am invested in. And again, this is not financial advice, it's just how I'm positioning. And also Microsoft, but you can see this as a larger proxy for IGV. In fact, if you watch my video, about Microsoft, you can see a very similar pattern playing out in IGV, although I think it's slightly different. And I could see this being one of those places where I'm long Microsoft and short IGV. A long short on that could be a really great play there, because I do think that Microsoft is going to outperform the other ends of the software sector, but not all of it. So again, I'd have to model that out. Let me know if you guys want to see factor residualization. I love trading like that. It's the real deep way to actually do a lot of this. I'm not just long Microsoft blindly because I think Microsoft's awesome and undervalued, although I may be in my long-term portfolio, but it's a little bit more nuanced than that, specifically when I'm doing, swing trades or overlays, meaning that I have a trade on top of a core position. All right, so yeah, that's it for the actual trade reviews. So let's look at the market forecast that a few users have recommended. So, yesterday we mapped out a clear forecast, but today I have to be realistic with you again that giving a concrete short-term forecast right now is incredibly difficult, simply because of the massive macro numbers that hit the tape tomorrow. However, there's one critical detail worth noticing, and as the trading day progressed, we saw a significant drop in volumes across the option market, which is really interesting, and I think you'd have to be looking at live GEX data to understand and see how that's playing out. But in some of the bigger names, volume dried up significantly into the afternoon, and what does that mean? It means two things. One, that I think people were aware that there could be a drop coming just from a technical standpoint today and didn't want to be positioned for it, but it means that a lot of retail traders stopped chasing, and large institutions finished their primary pre-CPI repositioning somewhere in the middle of the session or early in the session. And then big money has already placed its hedges and set its parameters. So they're locked in, they're loaded in, they're just kind of waiting for the data, just like we are. But if you're looking for very specific levels for tomorrow, let me give you some kind of back of the envelope starter levels in the S&P so you can see for what kind of insane range we have tomorrow. And personally, I would be interested in only trading based on those levels combined with volume and GEX with very tight stop losses. So if we look at the S&P, again, I don't really have to go down too small of a time frame to just show you this. And actually, I think maybe the best way to show it, we could just do it here. Let me zoom in a little bit. I was going to show you on the cues. It's even crazier. But these dots here, these are pivot points. So here's the actual pivot point, and here's support 1, 2, and 3. And here is resistance 1, 2, and 3. And essentially these are mapped out based on today's volatility. And as you know, today was quite large volatility, even though it had tightened up range-wise because of the day before. So essentially, if we look, back to yesterday on Monday, right? It traded in a much tighter range than had been assumed because the day before of it was such a big drop. So that insinuated, because it was small compared to its range, and if you actually do the calculations for the pivot points, that today's range would be tight because the previous day was tighter like that. But today had this massive volatility, and the calculations then therefore for the range are quite big. And now what I want to point out to you about this range is you may just think these are abstract numbers, but when they start to line up with other points of confluence, I can take take them more seriously. And I'm actually going to go through a few of these points for you, and you could see exactly how they behaved, because it is kind of wild, and particularly on some individual names, it's wild. But if you look at the low point for tomorrow, it almost lines up exactly with, this is the, let me zoom out a little bit here. It's actually hard to see with the amount of lower graphs that I have, but this is the 200 SMA. It's also a breakout point that I have marked from, wow, that is quite a range. If we came all the way back down to 684, I would be flabbergasted, but that is the not an expected range, but that is a pivot point there. So it wouldn't be out of the realm of possibilities. However, that would be a really juicy place for me in particular to buy. I don't want to list these as the spots in which I'm buying or saying these are good places for trade. What I'm saying is there are confluences around these regions, so nobody should be totally surprised if that happens. But that's a massive move. I think, let's see how far of a percentage drop that would be. At which point I really would be interested in buying it personally. That would be a 7% drop. Crazier things have happened. And if we look at it from the highs, from 760 down to, what is that? It's a 9-point drop, so a 9% drop, 9.5%. That is not outside of the realm of possibilities, especially when you've had a run up in the last few months on the SPY, we had a run up of 20%. So a 9% pullback wouldn't be out of the realm of possibility. Plus, it would be really great support. I think it would find support there. And again, this is not a forecast on what's going to happen tomorrow, because I wanted to show you how large it could be, so you have an understanding of how much risk is involved with tomorrow, even though I think a lot of what happened today was scaring out a lot of some of the weaker hands. Again, I don't believe in individual institutions doing this. I think that this is more just the composite operator, and the market wants to go to where that liquidity is, and once that liquidity is gone, it will behave accordingly. But speaking of pivot points, just because I want to throw in a little bit extra into this one, since I didn't give many trade ideas, I'll give a little bit of technical analysis. Let me turn off the extended trading hours here, and you'll see these pivot points start to reiterate here. For example, we fell right through this pivot point, and when that happened, we had a problem. And you can also see these wicks are starting to come off of it. Today we ended almost exactly at S1, and that happens a lot of. S1 and 2 were very close, and when they are very close, falling through S1 and S2 usually leads to S3, which is actually fairly uncommon to actually hit S3, even in bear markets here. So this was actually a pretty good place if you were coming in to get long. And I assume that was part of the assumptions for the people who took those swing trades to get into it. But I love pivot points over here. We could do a whole video. I mean, even if you look 2 days back here, same thing. We break S1, we come down to S2. We break S2, and we come back up to it on the pivot. They are... I can't explain how often I use these. These are being calculated on my screen, but they're also being put into algorithms so that they can day trade on those levels. And you can see how well they work, especially across days there. I think QQQ may have had even crazier ones today, if I recall. Same thing, ending at S2 instead of S3 here. This was a bigger move. QQQ tends to overshoot. I think on Microsoft, we actually saw just really great levels on that too. Same thing, ending up at S2. Everybody kind of ended on S2 there, which is interesting. But it also does mean that it was a down day in general. S2 is not where you want to be finishing the day if you're a bull. So anyway, that's the forecast, just essentially saying be nimble tomorrow. Be very nimble. I have taken off a lot of risk. I mentioned that yesterday. And when I say be nimble tomorrow, again, this is not financial advice. This is just how I'm trading the markets. So let's take a moment to wrap up with the macro watch. So tomorrow, I've mentioned it all video. It's the main event. Yeah, it's the CPI inflation data. And then on Thursday, we follow that up with the PPI on Thursday and the consumer sentiment on Friday, preliminary numbers from University of Michigan on Friday. So I'm keeping my risk tight. I'm keeping my head cool, and I'm letting the numbers dictate the next trade. And specifically, I'm looking at a lot of pivot points for tomorrow and where there's correspondence with Fibonacci's, retracements, moving averages, and pivot points. And I think you'll have a really great, and in fact, I mean, yesterday we called out, I don't want to be the YouTuber who mentions the levels that they called out, because I'm wrong on those all of the time. And the point is to know which levels to look for and what you're going to do at those levels. 690 was that downside case that we had been looking for a long time on QQQ. So a lot of people were probably looking for 700, but 690 proved to be that level. I don't think that we're out of the woods yet. But that being said, it was nice that it respected those levels. However, for everybody who likes when stuff gets bought on the dip, just realize where we finished. And again, it's just another inside day insinuating that there is volatility, but there are buyers who are stepping up down there. But this is some elevated volatility with elevated volume. So just keeping the heads cool going into the the major week. And like we said on Sunday night, we are in the day before the storm, not the day after the storm. So this is that week for that. So if you appreciate these deep structural market breakdowns, please hit the like button, subscribe to the channel, and make sure your notifications are turned on so you catch all the videos tomorrow. It's going to obviously be a post CPI video tomorrow. So let me know in the comments. Also, if you like the Wyckoff video that I did on Microsoft, I feel like there's not a lot of videos that are doing longer term analysis on a very academic subject, but on non-stale data and unfolding in live time. And also it's a trade we've been talking about for a long time. Curious to see how that plays out, but I'm also curious to see how that video found you all. So thanks so much. Appreciate it. Happy trading. Stay safe out there.